Kamke here with Michael Garcia. We're going live here. We normally do our agent panel this week at this time, but Chris is traveling, so I thought let's get on and share some value still with those of you guys that follow us. So Michael and I are going to be here. I don't know if we'll have anybody jump in as well, but I want to talk today a little bit about some of the misconceptions out there around life insurance, annuities, and I see a lot of Dave Ramsey content where he's just absolutely trashing and bashing whole life insurance. And a lot of the foundational strategies that we utilize, we do use whole life insurance, and there's a lot of misconceptions around those. I'm not as knowledgeable on the annuity side, although gaining those nuggets now, and I know Michael, it's something that you know quite a bit about. So today, I think it'd just be good to share some of the things that we see in the industry as people are thinking about going from middle class to generating wealth, and maybe some of the differences in thought process and how we utilize the tools around life insurance, and where is it sold to the middle class, and how are the wealthy utilizing that tool differently, and where do annuities come into all this. It's something that I know I've been gaining the knowledge on the annuity side, and it's been very cool to find out it's kind of like opposite of life insurance. You're guaranteeing income instead of guaranteeing a lump sum, and there's just so many gaps in financial plans across the board that life insurance can fill, annuities can fill. It adds efficiency, it adds security, it adds confidence to what people are doing with their money. So let's jump into that conversation a little bit. Anything you want to start off with, Michael? Just some general thoughts. Introduce yourself a little bit, maybe.
Yeah, now, you said something interesting. It's the annuities are the opposite of life insurance, and if you're a licensed agent, or if you've ever taken the exam, it actually just says exactly that, right? It says life insurance is about creating an estate. I've heard it said that life insurance is the only way to print money, right? You literally write a contract, you sign it, and your family has a huge estate in place, right?
Yep.
Obviously, you pay for it, right? Whether it's a term policy or whole life policy, you've got to pay your premiums. But you have a larger pool of money there for your family now, right? And so, and then annuities are the opposite. It's not about creating the estate, but now it's about the distribution of that estate, right? Paying it out. So, yeah, two completely opposite products, and both have their place for sure. It's just what stage of life are you in, and what's the game plan? And I think too many people, you mentioned like Dave Ramsey, or some of the gurus, right? Is they'll knock insurance, or they'll knock a certain investment, but it's like, no, where does that investment fit? And I think sometimes they just look at it with the wrong lens, right? And I'll say this: if you're looking at it from the lens of an investment, then Dave Ramsey's absolutely right. It's a horrible investment, right? In terms of, is it going to get you great returns? No, it's not going to get you super returns. It's going to get you 4 to 6%, like clockwork, though, right? It's something that it's guaranteed. It's going to be there when you need it. It has extra benefits, not just death benefit, but living benefit. So it's a real foundational piece to your puzzle, right, that you can build upon. But I kind of use this example, Jeff, and you can add to this or comment, but it's like if you're building a retirement portfolio, it's like building a skyscraper, right? So if you're going to build a skyscraper, you got to build a strong foundation. So if you look at your financial pyramid, you got your foundation where all your safe money is on the bottom, right? And it's wide, so it can hold the rest of the foundation. And then you got your middle area, which is your medium risk investments. And then at the top of the pyramid, you got your high risk investments. Now, if you were to flip that and you put your high risk at the bottom, your whole structure is going to fall, right? So in the same way, if you're building a skyscraper, you're building your retirement, and you're using whole life insurance as a foundational piece, number one, you don't want to take any risk in the foundation. You don't want to compromise the foundation. So that's one of the reasons why we don't use IUL, because of all the risk and the compromise that you would put into that foundation. But you wouldn't ever walk away. You wouldn't lay a foundation and then walk away and not build the skyscraper,
Hmm.
And in the same way, you wouldn't just put money into a life insurance policy and think it's a retirement plan. You still got to go build your portfolio on top of it, but it gives you a foundation to really build on top of.
Yeah, I totally agree. I was thinking of going the same direction. I think, one of the things that I've seen in my years in these financial services is that everybody's focused on rate of return. Everybody wants to talk about, the market's going to get you 8, 10, 12%, depending on what guru you talk about. They give you a different number, which I always crack up at. But that's where everybody starts from, and that's what sounds good. That's what sells. And like you said, with whole life, a lot of times it's mistakenly compared with investments. And we just had a client call this week where this gentleman, he works for State Farm. He's on the tech side. He's not a salesman, but he knew his stuff inside and out. And he was just laying out the questions, thinking we were coming from it, the standpoint of this is an investment. You should put your money in here and it's going to grow like wildfire. And I was like, no, dude, I absolutely agree with you. Like, this is an investment. Anybody that's trying to portray it as an investment, or somebody that's trying to use marketing to bash whole life by saying it's an investment, just doesn't know what they're talking about. And if they do, then they're being malicious with that. And so if you have a whole life policy, and the way we teach it is, like you said, a foundational asset. And it's so inverted the way that people are taught to go about their money. They're taught to invest first without ever taking into consideration, are they saving money? If they are, where are they saving it? Have they ever thought about, is there a better way to save than just a checking account or savings account? Maybe a money market account. I mean, some people talk about that and that's what they utilize. But is that still as good as it can get? And nobody's really looked at that. Nobody's asked that question. And I find so much through life, if we're not asking better questions, looking for deeper answers, we're not going to find better solutions. So, a lot of times, for a client, a whole life insurance is the perfect place to store capital, to save money, to have it for that, because it's doing multiple things at the same time. You've got the liquidity, you've got something growing, but you're also purchasing a death benefit, and you've got protection with the money that's in there. And there's a lot of things that can do for you throughout life. And I know a lot of people, if they have a good savings account, then they're not going to go and get high interest credit card debt if there's an emergency. And a lot of people don't save because there's not a plan to save their money with. When we have a whole life, there's more of a plan and a strategy and a structure that comes with that we're helping coach clients with. It's not just saving willy-nilly. And so many people have what's called Parkinson's law, as we know, in finance, where, if we have a paycheck come in, it's human nature to spend most or all of it. And if we don't have a plan to execute a certain amount of money to go into a policy for the cash value, more than likely we're not going to do that. But if we have that and we're able to continuously put money into that, then if the water heater goes, or we need a new roof, or the transmission blows. I've had 2 friends just in the last week that their transmissions have gone out, and one was a $15,000 repair. Luckily it was under warranty. Another one was like a $7,000 repair that wasn't under warranty. Okay, well, where are you going to come up with that money? A lot of people, they have to go get a credit card and put that on credit at 10, 15, 20, 30% interest. And that just perpetuates the debt cycle that so many people are in. Whereas if you have access to capital that is, it's a policy loan, you're going to pay 5.5% for that loan, but it's in a much better instrument that isn't going to just continually spiral you out of debt. Obviously, you still got to be responsible with that, but it's access to capital that can help people in that situation not incur more high interest debt and bury themselves. So I think that's one of the high points that I see as a thing that a lot of people deal with that the whole life can help solve. So is there any other things you want to comment on that, or anything else that you're seeing, in your practice, that where does whole life fit in? And maybe where are some of the things that the gurus are saying, avoid whole life, that, they're off mark, and you would point them in the direction of utilizing it, and what would some of those reasons be?
Yeah, I think, you hit it on the head, right? It's the emergency fund, right? Average credit card rate is 22.99% right now. Mm-hmm. I've seen credit card rates 29.99. I've seen 34.99. Mm-hmm. Absolutely ridiculous, right? And when you want to focus on rate of return, a lot of people, they just want to play offense, right? Mm-hmm. But how many have heard the saying, like, defense wins championships, right? So if you have the emergency fund, you have the defense in place, you're not going to fall victim to 34%. Like, it's almost predatory what these credit cards are doing, what these companies are doing to people. But you're not going to fall victim to that if you're prepared, right? If you had a strategy that took that into account. And when you talk about rates of return, well, Jeff, what investment do you know that's going to guarantee you a 35% rate of return every year? Like, take care of your debts first, play defense first, right? Mm-hmm. And then, like I said, build that foundation and then take the risk. And then when you talk about rates of return, I think the problem is a lot of people, they focus on like a buy and hold strategy, mm-hmm. right? But if you and diversifying, right? And when you pay attention, if you look at like Warren Buffett, if you look at Robert Kiyosaki, if you look at Grant Cardone, all these people will tell you to save first. And they all tell you also, by the way, don't diversify, mm-hmm. which is interesting, right? The opposite of what these gurus are saying is don't diversify. Position yourself. You know, Warren Buffett is always in cash. He always has cash at hand. Why? Because he's waiting for an opportunity, right? He's waiting for something to go on sale that he's not looking for a 10% return. He's looking for a 50, 100% return, mm-hmm. right? And that's what even Grant Cardone teaches is like, no, you can't invest first. Go save your money. He said, stack 5,000, 5,000, 5,000, 5,000. Before you know it, you got $30,000. And he says, now go find a 20% return. Mm-hmm. And so by following these strategies, you're not going to get the return in the policy that if you're trying to compare it to the investment. But remember, it's about control and liquidity. So you're in position to go get the bigger returns. Mm-hmm. Right. By the way, if the market drops 40%, how much return do we need just to break even?
I'm more than 40.
67% return. Mm-hmm. So if we position ourselves in our whole life policy to, gradually get the 4%, 5, and then when the market's right, when the opportunity strikes, we're in position to buy. Well, guess what? Well, everyone else is just breaking even. We just had a 70% return. Mm-hmm. So yeah, it's about the strategy. It's not, like I said, the whole life is not the investment, but it's about the position that you put yourself in.
Yeah, absolutely. The client that I was referencing, as our conversation evolved, he was talking about a universal life that he had years ago, back in 2008, that he did a policy loan with, and he basically put that money back into the market after the market, was near the bottom, and he wrote it back up. And obviously that's hard for the average investor to do that like clockwork every single time. But he understood the principle of the opportunity and having capital for an opportunity. And it's not just having a savings to get you through emergencies. It's, I think many people in finance can agree we've been on a very long bull run. So what's coming next is probably a correction in the market. And, it could be a rough one. We don't know. I mean, there's a lot of speculation on how bad it is going to be. You could listen to different people on that and their opinions, but, more than likely it's coming. So that's when there's opportunity for real estate on sale, buying businesses on sale. A lot of different opportunities out there when it's, really, really bad situation. I think last week on the agent panel, we were talking about, during the Great Depression. And I know I've heard stats of, the number of millionaires that were created during the Great Depression, because in those situations, a lot of people, if they have the thoughts and the thinking right, but then if they have access to money, they can pounce on the opportunities that are there in bad times. A lot of people, if they don't have access to cash, they don't have extra money laying around, they're going down with a ship. Whereas those that are positioning themselves where they've got capital ready to deploy, then they can pounce on those opportunities. And I know, several people, in the real estate world, they always say you make money on the buy. I know Chris talks about that. I think Garrett talks about that. Grant Cardone talks about those kind of things. Like, you always want to acquire real estate, but you always want to be, the moment you acquire it, you already want to be in a position of profit, not wait for 5 or 10 years to pass by and appreciation to take over, the cash flow from tenants to make you in a positive position. You want to do that on the front end, and having access to capital can allow you to do that. If you want to go after real estate, a lot of times, the people you're up against, they might have to go and get the loan at the bank, and it's a 30-day turnaround cycle, maybe even more. If you've got liquidity in a life insurance policy, boom, maybe 72 hours later, you've got the money to grab that real estate. And so you can move faster and grab those opportunities when they're available because you've got the liquidity. And that's one of the great aspects of the policies is that, attribute. So another thing that I think is very powerful, I've been watching some content around college recently. My children are still young, but it's good to know these things and how whole life can help with college planning. I know it's not a replacement for a 521 or 529, much like a 401k. Whole, life insurance isn't the replacement, but it can work with them. And there's some strategies that I've been learning about using whole life as a storage vehicle for capital for the purpose of, education or a career for your children, and how that can help with keeping and I don't remember all the technical terms with college, but keeping your earned income below a threshold so that you can apply for more financial aid, because that instrument is off the radar screen of the IRS and a lot of the tracking of your finances. And so it's a great strategy to help. You can still have money, you can still be growing money and have control over capital, but it doesn't hinder your children's ability to go do college and apply for financial aid in that way. And I think that's a great strategy that's not talked about a whole lot. In the infinite banking space, it's more about, the other cool, sexy stuff that you can do with becoming your own bank. But I've thought that's a really cool thing. Do you have any knowledge or experience with that aspect, Michael, with a college, or maybe it's not even college, it's career planning, it's apprenticeships, or, having your kids start your own business? Any thoughts around on whole life in that?
Yeah. When it comes to life insurance, it's not counted against you. So it's one of the reasons I have a policy for my daughter. If she wanted to apply for financial aid, scholarship, grant, whatever she can get from the school, from the government, we don't have to disclose that we have money in a life insurance policy for her. Whereas if we did it through a 529, we would have to disclose that money, right? So when we have that money, that could disqualify her for these extra benefits. Whereas now we don't have to disclose it, and she might qualify for the extra benefits. So, that's kind of another it's a return that is kind of hard to calculate, right? Because until she actually applies for something, we don't know what that value is. But it's another thing about it's positioning, right? So you could look at, okay, you got 5% return in your life insurance policy, but look how much money we saved when she actually went to college, right? Because we qualified for certain things, right?
Yep.
And what people don't realize is, whether you're using it as a volatility buffer or income stream or whatever you're using your life insurance for, if you're borrowing, that's not income, right? Which is why you don't have to disclose certain things. You can still qualify for certain programs because it's not income, it's debt, right? And so what we do is we leverage debt, and it allows us to avoid taxes, right? Just like if you took equity out of your home, it's one of the reasons real estate is even if you're not, and I know real estate, can be an asset or a liability depending on how you utilize it, right? Because if you cash flow the home, you have tenants in there, and you have a positive cash flow, it's an asset for you. And of course, if you live in it, it could be a liability, right? It could take money out of your pocket. It's an expense, but it's still valuable in the fact that you're still getting the appreciation, right? You're still protected from inflation. Everyone else's rents are going up, and your mortgage is staying the same, right? And we've all had those people in our lives where they're older and they say, "Oh yeah, I pay $800 for my mortgage," and you position yourself to be in that kind of situation. So, even in real estate, you get those benefits that are kind of hard to calculate over the long run, right? But you take the equity out of your home, just like in life insurance, right? You don't take money out of the policy, right? Just like you don't go into your basement and find the money you want to take out of your home, right? You actually have to go to a bank, and then the bank's going to loan you money. And so in the same way, you borrow against your policy as collateral, And by the way, when you take money out of your home, it's not income, it's debt. Therefore, there's no income taxes. And so that's the strategy of, leveraging money and not paying taxes.
Yep.
So life insurance, I look at it as a very close asset class to real estate. And even if you look in the tax code, you got 1031s and you got 1035s, right? It's interesting how close they are together.
Yep, for sure. I think my last thought on the college side is, a lot of people that are solely using a 529, that's all in hopes that they go to college, and it functions much like a 401k. Whereas if they don't want to go to college, that's not the purpose, that the child discovers for themselves. They want to go, be an entrepreneur or do something different that doesn't require a college education. To access that money, you got to pay a fee, and a lot of people don't necessarily understand that or think about that because college is so heavily promoted. But if you have a child that wants to do something different, having access to money inside of the cash value, whether it's through policy loan, like you mentioned, then that money can go wherever they want to go. It can be for down payment on equipment if they want to start a construction company, or it can be for an apprenticeship if it's not already paid for by the employer. And there's a lot more flexibility that brings that I don't think a lot of people understand. Sometimes the trap that can be there with a 529, if it's great if a kid wants to become a nurse or a lawyer or something that you definitely need a college education for. But I think a lot of people are waking up to the fact that college maybe isn't all that it's sold to be or has been sold to be, and that there's other avenues like being a real estate agent, being a insurance salesman. There's a lot of different things that can be a solid career that can make much more than you can if just by having the college degree. But the funding side of that to get into college and then to get into these other things, the 529 can have some limitations with it. And if you're okay with that, great, do that. But if you want a little more control over money towards those things for your children, that's where the whole life cash value can be a good supplement. Or some people maybe even choose to do a full replacement, not even have the 529. They want full control over that. Maybe, potentially not as much growth in the cash value as you get in a 529. But if we're in a downturn in the market, you might be further ahead. Who knows? It depends on the stage. So I think another thought that I'll bring up is, you mentioned the volatility buffer, and something that I've been explaining to a few clients recently that don't. It's amazing to me, Michael, the amount of things that clients, maybe they've used a fiduciary or a financial advisor in the past, and the things that a client still doesn't understand about their own personal financial situation and planning for worst case scenario. I see it with Dave Ramsey a lot and some of these other ones that they're always promoting best case scenario. Put money in the market, it's going to grow like crazy. You're going to have these millions of dollars in retirement. You don't even need life insurance because you're self-insured. Everything's going to work out great. And I mean, a lot of people, even if you read comment sections on YouTube videos from some of these same ideas, people are like, yeah, but that didn't work out for me. I didn't have the extra money. I went through a divorce. I had a health condition. Life happens for people. And, when we get into, talking retirement and the volatility buffer, one of the things that I find that, is not talked about is what happens if you're in retirement and we go through a several year period where the market's correcting, it's down 20%, 30%, 40%, and you're trying to live off that income. And the volatility buffer concept is if the market drops 20% and I'm still trying to withdraw my $50,000 of income out of my portfolio, that's a double dip against the principal, right? It went down twice in that same year. It went down because of the market loss, and it also went down because I withdrew money. Well, now, I'm in a worse position. I might not have as much money. It might not last me through my entire retirement because that happened. And if it happened again, it might completely wipe somebody out. So the volatility buffer is we can have our money in the investments in the qualified monies. And if the market goes down, great, we've got a plan B. We can go and pull, either do a withdrawal or a policy loan from a cash value of a life insurance policy. And that's the buffer through the volatility to get you through that, pull that money from there, let the market hopefully recover, and you're at least only having the negative effect on your account just from the market. You're not making that withdrawal. You're making the withdrawal from a cash value policy, and it helps you get through that and maintain the principal the best you can. Hopefully it restores itself, and maybe you've got 2 or 3 years of cash value to get you through that, and maybe you're totally fine. You can rebound the full value of your traditional accounts and then begin to pull out of them again once the market has come back to where it was. And that doesn't put you in jeopardy of outliving your money. And that's something that a lot of people aren't thinking about or planning about. There's a lot of advisors that aren't really handling that. And that's one of those gaps in a financial plan that whole life can serve that. So any other thoughts around, the volatility buffer aspect in retirement, Michael?
Yeah, as you were saying that, I was thinking, for the people that are all about rate of return, right? The rate of return doesn't mean anything until you sell, right? So if you got an 8% rate of return for the past 20 years, right, and you tripled or you even 4x your money in the market, but then right after you retired, we had a crash 40%. And now you're selling your stock on sale. What rate of return over the past 20 years did you actually get? Right? Because you just lost half of what you thought you had. And the only number that actually matters is what you sold your stock for, which was 40% what you had done, or 60% of what you had gained, right? So you didn't get the rate of return you thought you were getting. And that's why these strategies are important, because you position yourself to say, hey, obviously, you mentioned you want to make money on the buy. You want to buy when things are on sale, but your exit strategy has to be good too. I don't know if anyone's ever traded. I've done options trading. I've done crypto trading. I've done a lot of different trading, and I can get in a great place, and I could see my stuff skyrocket. I'm like, oh, I'm good today, right? And then all of a sudden you see a little dip and you're like, oh, it's just a little back step and it's going to keep going. But then all of a sudden you're at zero, right? And you're like, what did I actually gain? Like I rode the wave up, but I didn't gain anything. And so without a good exit strategy as well, you put yourself in that kind of position. And that's what having a volatility buffer outside of the market allows you to do, right? Because you're over here in this other account, or in the policy, you're gaining 5% every year, 4%, 5%. Let me just borrow from that, or let me, even just take money out of that, without borrowing. We could do that too, and then we can let our stocks recover to a price that we feel good about selling them at. So,
yep, totally agree. I think let's end on this last point. I think around alternative strategies when it comes to financial planning that we utilize we talked so far about cash value life insurance, but annuities, I think, fits this discussion where we're at right now with. It's one thing to focus on rate of return and accumulating this huge pile of cash that's supposedly going to solve all of our problems. We don't need long-term care because we got a huge pile of money. We don't need life insurance because we got this huge pile of money. We're self-insured. It's going to take care of all of our problems. But one of the things that doesn't get asked by very many people is, are the traditional places to grow our money the most efficient places to actually convert that growth into cash flow? And where do we get cash flow in retirement? Is a 401k the best place for that? Is it the most efficient use of that type of an account when we've got taxes coming out? If we want the money before 59 and a half, we're paying 10% penalty, those types of things. Is that the most efficient way? Or are there other efficient ways to gain cash flow in retirement? And I think that's something that annuities come into that discussion of, it's one thing to practice growing our money all of our working years, but we also need to be practicing and having the right strategies and tools that are going to help us be successful in retirement for the cash flow that we need. And a lot of times, if we were solely focused on growing this huge pile of money, maybe the client doesn't even know that much about how to get cash flow. What are the different problems that can come up through retirement that can, cause, like we've already outlined, if the market goes down, you just took in your example, Michael, 40% hit. Like you're going to get 40% of the cash flow that you were planning for. So what do you do in those situations? How do you, yes, there's Social Security. Who knows how long that'll be around, but you need to be in control of your finances. And that's a place that annuities come in that can guarantee your income for life, so that you're not going to outlive your money. You have your basic needs absolutely covered. I think one of the powerful points that I've heard in some of my research recently on annuities is there's data that suggests people that have annuities, that have guaranteed income streams from an annuity, live 20% longer because they have less stress about money. They're not worried about, am I going to outlive my money, or do I have enough cash flow? Do I have to live on rice and beans through my retirement, or do I have to go become a greeter at Walmart just to make ends meet? That's a huge burden. So I'd like to hear your thoughts on, the cash flow and retirement part. Where do annuities fit in, and some of that?
Yeah, I think there's a few fears in retirement, right? One could be running out of money, outliving your money. Annuities can solve that problem, right? Another one could be your hospital bills, long-term care. Annuities, some of them do have options where they'll pay out double if you qualify for long-term care for up to 5 years. This is also why a whole life insurance policy with long-term care should also be in your portfolio when you retire, because it's a protection for the whole retirement structure. Back to the skyscraper that you built, right? Which is your portfolio. If you don't have to, if you suffer an illness and you don't have to dig from that, you don't have to take down that skyscraper to pay for your illness. You can leave that up for your spouse. Because last thing you want to do is, hey, I got ill, I'm going to eat up all my retirement money, and then when I pass away, I'm leaving my spouse with nothing, right? And so having this extra other source of funds is definitely super valuable in protecting your portfolio. So you should have annuities. You should have a whole life with long-term care also in there. So you can protect against the hospital bills, right? Those kind of things. Obviously, there's market risk. That's another place where annuities can protect you from the market risk. I like to work in guarantees, Jeff, by the way, because there are annuities. It could be kind of like a minefield. There's certain annuities out there that aren't guaranteed. They might look really good on paper,
Right.
but they're not going to be great for the client long term, right? And then there's going to be other annuities that everything in the contract is guaranteed. Might be like a guaranteed bonus, guaranteed roll-up rate, and a guaranteed income. And so I like to use the guarantees. But yeah, you're not going to worry about market losses. You're protected against that. So it comes down to that client, where are they at? Obviously I definitely recommend, if we can guarantee all your your living expenses, let's do that. But then there's one area where I think, okay, we don't want to put all the money in the annuity. We still want to have a growth bucket of money, because there's one more thing we got to think about, and that's inflation. So I think it's a big part. As I talk to seniors and people that are looking at retirement, they definitely prefer to go the guaranteed route. By the way, there's annuities that can guarantee growth. MYGAs can pay up to 6% right now, guaranteed on an annual basis. And there's even some accumulation annuities that one of the problems in the industry, Jeff, is, and it's the same thing for like the IULs, right? These companies, a lot of them, they'll reduce the cap rates, the participation rates, so you're not going to get what you thought you got. But there are a few companies out there, Mass Mutual is one of them. They have a cap rate lock, right? Investors Heritage, they guarantee that, hey, as long as there's any fees to get your money out, the surrender period, we're not going to lower the cap rates on you. So I like to go with those kind of guarantees if a client wants to go in the market. But the way I see it, if I can get 6% guaranteed, I'd rather do that than see if I can get a little bit more, because like you said, the outlook for the market is, hey, there's got to be a crash coming sometime, right? Yep. And so if that's what your belief is, you wouldn't want to necessarily go with a fixed index annuity that could underperform, right? So it depends what your beliefs are, but in most cases, I'd rather go with a MYGA. But yeah,
for sure,
it's going to protect against all those fears in retirement. And so, yeah, I can see why people live longer, not having to stress about those kind of things. Definitely a big deal.
Yeah, for sure. I think the last point from what you were talking about made me think of, just the idea of the permission to spend. I forget who wrote that book. That was it. Maybe Tom Wall, was that his book, Permission to Spend? I forget, but basically the idea, and Tom Hegna's talked about this some. It was a industry, guru on annuities and life insurance and how that fits into a portfolio. And he's talked about, having the annuity streams of income. And the whole idea is to spend down your money because you've got life insurance, the death benefit that's going to replenish. You're not trying to let the big pile of money that you've accumulated also be what you use as your legacy play to impact the next generation. That's what the death benefit is for. And it gives people the permission to spend what they've worked their whole life trying to accumulate to enjoy retirement, because so many people have that belief that, well, I'm going to scrimp and sacrifice all my way through my working years and then turn the dial in my life to, once I get to retirement, I'm going to then start traveling and start doing all this fun stuff. And a lot of people don't even do that. They maybe pass away before they even get to retirement, or a year or two after retirement, because they lost purpose in their life, or they get sick, because of their job that they did for 40 years. It, created cancer or something like that. And then that someday syndrome, they weren't even able to capitalize on all the work that they did to put their money away. So, if you can be in retirement and utilize the money to do the things that you want to do, to, not just scrimp by again in retirement, but live in a way that is, enjoyable. You're enjoying your money and being able to do the things that you want, and you're not held captive by, a certain amount of money that's coming in from Social Security. That freedom is, you can't put a price tag on that. I mean, I think a lot of things we've talked about today, is kind of that external rate of return is really hard to put a number on with what life insurance and some of these annuities can do in your portfolio and do in your life, and the effects that they can have. It's really hard to calculate that down, but there's some powerful things that, unfortunately, are the things that I don't ever hear talked about from the traditional talking heads that bash these two products and these two tools, where I think we've outlined pretty well just in our 40 minutes or so that we've been on, some of the things that are very necessary for people's success financially in their life, in their working years, and in retirement. That, I don't know what the alternative solutions are for some of those things. I mean, I think there are, but are they the most efficient? Are they really in alignment with your values and beliefs and what you see with your money? I don't know. That's something you have to look at. So I guess any closing thoughts here, Michael, before we wrap it up?
Yeah, I think, when it comes to money, our buddy Chris, he says math and money aren't the same thing, right? They're different. And when you talk about money, there's the human psyche, the mental state that comes into play, right? It's one of the reasons that people have a hard time trading, because their feelings or their emotions get in the way. And so as you're talking about enjoying your life, when you don't have those guarantees in place, there's a fear that takes over, right? Oh, I can't take that vacation because what if I overspend and I outlive my money? And because I don't know what the future holds, right? I don't know if the market's going to crash. I don't know how long this money is going to last, right? And when you can kind of take those things out of the equation, you don't have to be fearful anymore. You can take that vacation feeling good, like, hey, next month I got the same amount of income as this month, right? Next month I'll never outlive my money. As long as I live, I'm good. So yeah, it absolutely gives you that permission to live. And same thing early on with life insurance, right? When you have that life insurance and you have the living benefits, knowing that there's money there to take care of certain things. If you got injured or ill, you can kind of let go a little bit and not live in fear, and just enjoy your life.
Yep. Totally agree. Well, cool. So are you streaming to any of your channels, Michael?
Yep.
Cool. All right. Well, good. To say, if you weren't, I'd put your info with mine, but since we're both streaming to our own channels, then everybody that's watching knows who we both are. So yeah, well, thanks for joining me today, Michael. I think it was a good discussion, and glad we could utilize the normal time that we took to talk finances and talk money. And yeah, been a great conversation. So I guess for those on my channel that want to know, maybe they like you and want to follow you, where could somebody find out about you, and what kind of content do you have out there available?
Yeah, so you can find me on Facebook, Michael Garcia. I have a business page, IC Life. That's the letter I dot letter C dot. And same thing on YouTube. Find my YouTube channel, IC Life. And yeah, Instagram, Michael G447. So
perfect. Awesome. Well, I'm
appreciate
well
it, Jeff.
centered. Yeah, absolutely. I'm wealthenergetics.money is my website, and then you can find me on YouTube at Wealth Energetics as well. So cool. Great discussion today, Michael. And yeah, we'll look forward to next week when we're hopefully back on with Chris. So.
Awesome.